Hello, everyone. I'm Donna Holly, the president of the Investment Institute, and on behalf of Andrea Zigathy and myself, we welcome you to our 9th Coffee Break Series session. A special hello to our editorial committee and our TII community who we see logged in for each of these sessions. Your support and presence continue to mean the world to us, and we are beyond grateful that you've spread the word about us to so many newcomers. We see so many new names here today, and Andrea and I welcome you and hope that you'll reach out to us to learn more about TII, and we would love the opportunity to learn more about you and your organizations as well.
Hi, everybody. I just wanted to say thank you so much for being part of this. Real quick, because you don't all hang out until the end, we thought it was important to let all of you know about our virtual forum. It is virtual, October 26th, 27th. There were many of you that registered for our outdoor event that we were going to host at the Angus Barn Pavilion. Just so you know, we cannot hold it this October, unfortunately, and we'll look forward to seeing you all in May in person. But this October, we're thrilled. We have such an amazing speaker lineup. And the keynotes, as you can see, Dr. Friedman, we actually have never had him to an event. So you don't want to miss Dr. Friedman. And Ted, who you'll see today, Ted Seides, he's incredible. You all know him from Capital Allocators. And I'm really excited about Dr. Greg Poland, who I've seen on a few webcasts now. And he's the director of vaccine research from the Mayo Clinic, and he's really excited to do this with us and be part of this event. So you can see all of them there. I don't want to take your time with this, but just please make sure you register as soon as you can. Really want to say a special thanks to iConnections. They have been so wonderful to help us because we're trying to live in this virtual world now, and we're so used to being together physically. And so we went to them and we collaborated for this event specifically so that you can meet one-on-one. You know, we've been doing a lot of one-on-one meetups with managers and investors, and with investors and investors, but this is a platform that we're really excited to show you. And we hope that you'll be able to participate in the forum and pick when you register that you want to do meetups and that you want to come to dinners. We're also going to have live dinners in different cities all around the country. So back to you, Donna.
And now on to today's session. We are so grateful to the team at Exos for introducing us to Brady Dougan. Brady was previously the CEO at Credit Suisse and is the founder of Exos, and we so appreciate him taking the time to talk to our community today on a number of subjects related to our digital world and all that he and his team are building. And Ted Seides. So much to say about Ted Seides. Most of you likely know Ted from his podcast, Capital Allocators, or from his many years in many different roles in the investment world. Ted is a dear friend of Andrea's and mine for years now, and we can't thank him enough for moderating this session today and also for supporting TII's mission for education and real connection in so many ways. A few quick logistics. Please take a moment, if you haven't already, to locate the Q&A button on your Zoom screens. What we ask is that as soon as a question comes up in your head, please do type it in. Ted will be reviewing them throughout and will do his best to incorporate as many as possible of them during the session. You will also receive an email today after the webinar with a quick survey link. We really ask that you fill that out for us. We really like your input on future programs that we're working on, so please take a moment to do that. The email will also include a link so that you can access the recording of this session in case you've missed any of it. For those of you who are interested in CPE credit, the email will also contain information that you'll need in order to submit your necessary documentation. Again, a huge thank you from us to Brady and to Ted for doing this today. Can't thank you enough. So glad to have you here. And with that, Ted, take it away, and thanks again.
Well, thanks, Andrea and Donna. It's always a pleasure to be asked and to be in this terrific community of people. This is pretty interesting to get a chance to talk to Brady. And, you know, I know we're going to talk mostly about what you've been up to for the last couple of years, but I'd be remiss if I didn't take us back a little bit. I know you spent 25 years at Credit Suisse, including being the CEO for the last bunch, and that included the time of the financial crisis. And you know, as I mentioned earlier when we were chatting, you were in the room when it happened. So as I say that, what comes to your mind from all of that experience in that quarter century at Credit Suisse?
Well, I think, I was very fortunate to be able to do a lot of things over many years. I worked in every region of the world for close to a decade, worked in all parts of finance and saw, whether it was everything from private banking to, institutional businesses, sales and trading, investment banking. So I got to see a lot of different parts of the business as they developed over time. And clearly, as you say, one of the interesting things was over that time, I was involved in a lot of what would be, probably considered some of the seminal events in the industry. So whether it was, as you mentioned, like the 2008, with the financial crisis, 9/11 was a big challenge in terms of managing a business in New York through that period. And that's obviously come to mind recently with the, with the 19th anniversary of that. A lot of very interesting, challenging times through that as well. And I guess I've always, I guess I reflect, and we look right now where obviously this is a very unusual period. A lot of things that none of us have ever experienced before. And, I just feel like the industry, the world, the industry is very resilient. I think that, what's one of the exciting things about it is that, we all as, investors, people in the financial industry, I think we, are able to figure out ways to adapt and to, make the, make the wheels of finance work, even in very difficult times. So, and having, as you say, having been there and watched, the financial system actually manage through those kinds of events, which are often very cataclysmic. I have a lot of confidence that we'll continue to be able to do that. So I guess, having seen everything that I've seen over 40 years, I guess it's hard to get too too desperate about how how things are going to proceed. So I have a lot of confidence that we'll be able to work through things in this case as well.
Right. So as you left the bank, which was, if I remember, about 2015, what was on your plate? I can only imagine the phone started ringing with all different kinds of opportunities.
Yeah, there were a lot of things that I was interested in. There were a lot of things that I outside of the area of finance that I was involved in. So I've done a lot of investing in biotech, for instance. That's something that is really interesting to me. In really transformational medical technologies. That's something that's really, really interesting to me. And I've been involved in a number of those, heavily involved in some, but involved in a lot of those. So that was interesting. There were, as you mentioned, a lot of different directions. I mean, obviously one of the things that people do oftentimes is take board seats and basically sit on boards. I have to tell you, that's really not for me. I mean, I have a hard time getting the balance right between being close enough to actually help influence management, but far enough away that you're not interfering. So it's probably from having been a CEO for a decade, it's just hard to do that. And I guess, I had formed a view, particularly post-crisis through the end of my tenure at Credit Suisse. So, I was named CEO at Credit Suisse in June of 2007. So I always mention I kind of got the booby prize. I think I was the last major financial institution CEO named before the crisis. But it was really interesting to manage through that and a lot of challenges. But I formed this view that, it's a great industry. There's a lot that goes on, but it is an industry that is ripe for disruption. I mean, you look at every industry around the world as technology has swept through, changed the business models, created, basically created brand new entrants that became dominant in those businesses. I mean, Sears Roebuck versus Amazon or whatever, all the usual comparisons that we use. And finance had been, relatively resistant to that. I mean, the leaders in finance now are the leaders that have been there for the last, 30, 40 years. And my view was that particularly through technology, there was going to be a, real transformation of the finance market. And, having been at a legacy financial institution for many years and at the top of one for a decade, I understood a lot of the challenges that I had and that those institutions have. And I also thought there was just a tremendous opportunity to create a new type of financial institution, one that was based on absolutely state-of-the-art technology, one that could actually therefore use that technology to leverage into all the business lines, provide better services, in fact, do things that existing financial institutions can't. So and the way we always say is think about Morgan Stanley or Goldman Sachs, but on an Amazon or an Alibaba type technology platform. Achieving that would really transform finance. And in my view, I saw a lot of great opportunities over my years in the industry, a lot of really interesting opportunities. This is the biggest opportunity that I've ever seen. And a lot of it comes with, technology really has developed, even in the last 3 to 5 years, tremendous development in the cloud and in the applications that have been developed for the cloud. I mean, I think we have the first cloud native institutional, 100% cloud native institution that's been built. And we were able to do that because there's a tremendous amount of technology out there that you can plug and play into the cloud in order to make a business work. So I think it's an incredible opportunity. I have a group of people working with me who also believe it's an amazing opportunity and done an amazing job over the past few years building the platform for that business. So it was the most compelling opportunity that I saw, and that's why I ended up doing it.
When you think about the functionality of financial institutions, and in particular the different evolutions of really balance sheet risk, among other things, in a bank, what were the aspects of a bank that you thought you could bring together, and what Exos is today?
Well, I think obviously the basic function of all financial institutions is to intermediate those financial flows. Get capital from people who are long the capital to people who need it, and to do so in a very efficient and productive way. I think that almost everything that an existing financial institution does can be done more efficiently and more effectively through modern technology, particularly data analytics. And so we have done a lot of different things where first of all, obviously, is just making things more efficient. So we can take existing businesses and basically manage them on a technology platform that allows us to conduct those businesses at a fraction of the cost. Secondly, it allows us to create offerings that are much more compelling for the users. And so that could be by using data analytics, bringing basic things that frankly all the other industries have really brought to bear very effectively in their businesses. I mean, if you compare what the retail industry, what Amazon has done in terms of using data analytics to serve their customers in a very efficient way. I mean, all of us use Amazon or Netflix, or they really use data in a very effective way. That really hasn't happened, particularly in the institutional side of finance. I mean, the retail side of banking, some of the retail brokers have done some of that, but particularly the institutional side of things, which is a huge market, has barely scratched the surface on that. So in our view, we could do all the things that are done currently, but much faster, more efficiently, and much better, particularly using data, using the power of the cloud. But also we can do new things that really a lot of those institutions are not currently doing. So we're kind of looking at a mix of those, moving into areas where they're not able to function today because they don't have the technology, and just doing things that they already do, but doing it much more effectively.
With that wide of a platform to go, where did you start?
Well, we tried to look at, in terms of the businesses, our view is that platform, that technology platform, as I said, so, Goldman Sachs, but on a Alibaba platform, the first thing we needed to do was to build out that platform. And so that's what we did. Our chief operating officer, head of technology, Joe Squarey, really built out a state-of-the-art, very, very powerful platform. And that was the basis for which we could actually build into every business that we're in. And then what we did was we looked at areas where, we wanted to look for areas where there was less competition for whatever reason. It might be a regulatory restriction. It might be, in many cases, technology. So if you don't have good technology, it's hard to do that. And I can give you some examples. So we looked at that. We looked at areas where technology really did give us a huge leg up in terms of pursuing those businesses versus the competitors. And we also looked at areas where we could use our structuring capability, because we have a lot of experience on the structuring side. And so areas that combine those three were the areas that we looked at. So right now we have about 7 different business lines that are up and running within the institution. We have 3 that are sort of on deck and ready to go. But I can give you an example. So, a couple of examples. We have a construction financing business where we focus on middle market type construction finance. And it's a great business. We basically originate the loans. We sell them off to other institutional players, sell off a senior tranche, sell off a mezzanine tranche. And that's something that, it's great value. And we think they're very high quality loans. It's not an area that others do because construction finance is a little messy. It's hard to actually track unless you really have great technology. So one of the things that we did was to build a really state-of-the-art technology, which we call Reveal, which allows us to actually track the construction, to make the payments over time, the disbursements. And that's something that's very, very powerful and allows us to do that business at scale. And one of the other things that we do, which is a really interesting part of our model, is we build the technology for our operating business, but we also then will license that technology to others. So our construction financing technology, which we call Reveal, we also have a couple of mezz lenders who are looking at licensing that technology as well. Digital assets is another area where we think it's a really interesting area. We think a lot of people pursue that from some relatively narrow verticals. We actually do it broadly. We think that's something that makes it really interesting. Our technology obviously helps us a lot there. And so that's another area that we, again, it sort of fits with, an area that's a little bit off the beaten track of the big legacy institutions. Technology really helps a lot. And we think there's a lot of structuring and a lot of things there that make it interesting. So, those are a couple of examples of areas that we focus on.
So those 7 business lines, and I do want to turn on to asset management, both digital assets and what you're doing in Spac. So those 7 business lines, how many of them are financial intermediary businesses compared to, say, a balance sheet business?
They're all, again, we try to do the businesses holistically. So we tend to do, like, another business which we started into was Spacs, about a year and a half ago. And obviously that's one of the hottest areas and, now, but we actually, a year and a half ago was a little less. It was still a pretty interesting area, but less hot than it is now. And our view of that was that we would approach it from a very comprehensive point of view. So we would do an advisory business, which uses no balance sheet really, but it allows us to provide advice to customers. We have an underwriting business, which uses a little bit of capital, but it's relatively capital light. We have an algorithmic trading business, which does use capital, allows us to use our technology to actually deal in the markets. We have a lot of structuring ideas around all those as well. So we kind of provide that on top. And then we do have an asset management business where we're managing assets in the Spac area. We think it's a very interesting space. And again, it's one where you have some big players, but they just do one piece of it. They may do, a large bank may do underwriting, but they don't actually trade the secondary side, or, they don't do the asset management side. So we think actually approaching it from an overall point of view allows us to do that. We tend to do, I'd say probably 70% of what we do is more intermediation, and maybe about 30% is a little more balance sheet intensive. So, we're still obviously smaller than our biggest competitors. So we're going to win more on the basis of technology and smarts and structuring than we are on the basis of capital.
Why don't we dive into that Spac investment opportunity, and particularly what you're doing on the kind of externally facing asset management side? It's in the papers all the time. How are you approaching the investment framework for the fund in Spacs?
Well, the fund that we've worked on jointly with Morgan Creek, which we call Spac Plus, we think is a really interesting investment product. And one of the most challenging investment areas we think for investors today is trying to come up with that short-term cash, sort of cash equivalent, relatively liquid but safe investment. And it's obviously very, very difficult. I mean, if you want to buy T-bills at 10 basis point, I mean, it's very difficult to come up with anything that actually suits in that area. And I think probably obviously, as you know better than anybody, I mean, all investing is difficult, but that's probably one of the most challenging things, is trying to find relatively liquid but reasonably yielding, short-term strategies. And when we look at SPACs, we found it's a very interesting area, right? Because they're equities, they're listed equities, they trade on equity exchanges, but for the first part of their life, they actually have a very fixed income-like profile. Because for those who aren't familiar, what a SPAC does is they do a management team gets together, decides to issue a SPAC. They do an IPO, so they issue shares and they get the proceeds from those shares. they take that money and initially they put it into a trust, which is invested in treasuries. And so that's the basic investment while they go out and look as a blank check vehicle for an acquisition. When they actually, if they're successful in finding an acquisition, then they announce the acquisition and the stock will trade wherever it does, often trades up because that's viewed as a good acquisition. Or if they fail to actually acquire something, then the investors are able to take their money back from the treasuries trust and basically get, you know, the proceeds of that. So in a sense, it's got equity upside, but it has fixed income, you know, protection on the downside, if you will. And we found that to be a really interesting characteristic. And we basically used that, adapted that in our Spac Plus fund to give what we think is a tremendous opportunity for people to deploy short-term cash in a fixed income like downside protected investment that also has equity like upside. So it's really unusual. So we take in the fund, we position SPACs. If those SPACs actually do a successful acquisition, then we'll sell the stock at a profit, often a reasonable profit above that. If they're unsuccessful in doing acquisitions, then we'll just redeem the treasury trust, if you will. So the downside is always the treasury, but the upside is sort of an equity upside. And so we think that's it's a kind of an unusual market and an unusual instrument, but it can actually be combined in the Spac Plus fund to be something that we think is very powerful. It has monthly liquidity with a fund level gate, but really we think a very interesting product that gives you the protection of a fixed income downside, but equity upside and liquidity. And so it's we think it's actually a really interesting concept and comes from being able to look at, you know, what is a slightly different market in sort of a novel way in terms of adapting that to create an investment product that is, we think, unique and really interesting right now.
From your kind of holistic purview of the SPAC space, do you see the market as offering inefficiencies, or is it just a vehicle that you view as a type of asset that has an attractive risk-reward characteristic?
I think it's actually interesting because I actually believe that it's in a sense it is an instrument that is optimizing for all the players involved, which is, you know, it's hard to find a win-win-win, right? But I actually think it is one where it's a superior return for investors, and we're obviously helping to do that through Spac Plus, but other investors who are Spac investors as well. It's also a great vehicle for sponsors, the people who actually, the management teams who launch the SPACs, because it gives them, you know, capital that's ready to deploy. It gives them a stronger hand in acquiring businesses and bringing them in-house. So it's good for them, but it's also good for the acquired companies. I mean, there are, as you know, there are a lot of players out there who are now viewing private companies merging into SPACs and going public through SPACs as a superior way to get public. And so I think it's one of those interesting developments where the whole market has actually, it's just it's a very efficient and positive way to take companies public, to in order for people to deploy their cash, you know, realizing the upside of those acquisitions, as well as we mentioned, from a cash management point of view. So it's really, I think it's really interesting, and it's structurally it was there, but it's developed even more so recently. And you know, one of the things that we think is most interesting about the market is it's kind of graduated from a market where you had, I'd say, more more mainstream industries that use the SPAC market to go public, to now you really have the high flyer companies that are very interested. So the Virgin Galactics and the DraftKings, and you know, it's really interesting, kind of high octane, and you know, not always up, sometimes up and down, but you know, very interesting companies that are using that as the vehicle. So it's a really interesting area.
Yeah, I mean, it's very hard in the capital markets, and particularly the public markets, where you think of zero-sum games, to imagine this sort of win-win-win. So the first question I would ask is who's losing? Is it Wall Street underwriters who would have charged more?
Well, I think that's one of the good things about it is I'm not sure there are any big losers. There are, you know, probably the people who take the most risk in this are the sponsors or the management team that issues the blank check vehicle. So, you know, their capital is entirely at risk. So if you will, they kind of have a profile, and, you know, they make good returns on it, but if they fail to do an acquisition, they'll lose all the capital that they put into the vehicle. So they probably have the highest risk profile, but they also have a decent return profile if they're successful. So if they're, you know, if they're successful in doing it, they can actually, you know, make a good return, but they're 100% at risk. So I would say in terms of the ecosystem, that's probably the area that has the most risk, but frankly, they're the most knowledgeable, they're the most sophisticated, they're the most knowledgeable, they control their own capabilities. Because there is really no downside for the investors in the SPAC. They're going to get, if they, you know, in the worst case, as we mentioned, right, you're going to get back at least treasuries. So that's not so bad. I mean, you might have been able to invest at a better return in something else, but that's not a bad downside given there could be upside. Companies that are using the vehicle to go public, it's just another route to do that. So I don't see any area really having, you know, being disadvantaged by it, but I do think that sponsor side is taking a lot of risk to make this happen. And they get very good returns when they're successful, but they are taking a lot of risk. And that's part of the lubricant, I think, that makes the market work.
So just to understand that a little bit better. So the sponsors are putting up capital to hunt for the deal.
Yes.
What are they paying for in that process? So,
well, first of all, they're paying all the money, all the fees to take the vehicle public. So all their legal fees to set it up, all their underwriting fees to do the IPO. So that's why as an equity investor, you can buy the SPAC and get your money back without deduction of fees. You're getting your money back plus some interest. So that sponsor is taking all that risk, all the cost of setting it up. And as you mentioned, all the cost of actually pursuing acquisitions over that period. You're funding all of that over the, you know, 6 months, 12 months, 24 months that you're looking for it. And so, you know, that's you know, the fees on SPACs are about 2%. So if you do a $300 million SPAC, you know, that's $6 million that you need to put up just for the underwriting fees, not to mention the other money that you need to put in. So it's not an insubstantial amount to put at risk. But again, you know, if you know your industry and you're confident that you can, you know, find good companies to bring public, then you know, that's something that you can control. So.
Yeah. So if you circle to the other end of it, I've always been curious. There is this, you know, they call it a promote or 20%, and maybe it gets competed down, that the sponsors then own in the continuing business after they complete it. I'm curious about that deal dynamic, because if you're a seller of a business, you know, and the owner is now, or the sponsor is now going to take 20%, it just feels like what price are you going to pay, and how do you make that all work?
It's a really good question. You know, I think first of all, many times in the negotiation when a private company works with a SPAC, a lot of times that's negotiated. So they don't always get that same amount of dilution. It could be that much. Oftentimes it's less. And, you know, sometimes it'll depend on the size of the target versus the size of the SPAC. So it varies, but it's still substantial dilution. I mean, you're exactly right. There's still substantial dilution. And so if you think about it from a private company's point of view, they're comparing, if I go public through a traditional IPO, I go through the whole process, I kind of don't know the answer until it's actually priced on the last day, right? And I do run the risk also that, you know, 2 days before I'm going to price it, my banks come to me and say, well, you know what, the market's not that hot right now, and so we're basically going to pull the deal, and that's not great, so you don't have certainty of execution. And there are also fees. You know, IPO is a 6 or 7% fee as well. So it's not equity dilution, but it is taking cash out of the deal. So there's cost in that as well. If you look then at a SPAC, and let's say you have, as you said, 10 or 15% dilution from that, should be probably on the high side. I would say 10% dilution from that. The advantage for the company is that by the time that deal's announced for the private company, by the time it's announced, it's all been negotiated with the SPAC. It's almost certainly going to be approved. Now, where the stock trades after that is obviously an open question. So exactly how you'll be valued after that's open, but at least you know you have a deal, it's been agreed, it's, you know, it's almost always approved by the shareholders of the SPAC, and then you're public. The other thing that's a real advantage in the SPAC process is that, as opposed to an IPO where the company that's going public has a lot of restrictions on what it can talk about through, you know, the registration process, and can't really talk about projections or what the company's, you know, potentially going to produce in the future. In a SPAC, it's an acquisition, and so the company is being acquired, and there certainly are still rules around it, but you can be more expansive around talking about the future prospects of the company, et cetera. So particularly for companies that are big. I think of it as, very transformative companies that have, big ideas that are going to potentially be, transformative for their industries. The SPAC can be a better way to go because you can tell you have a couple of months between the announcement of the deal and when it's finalized, when the stock actually starts trading, where you actually have a stock that's trading that assumes that you're going to acquire that company. And so that message can get out and people can buy the stock over that period and reflect, their optimism or lack thereof of that company's future. So there are a lot of advantages to the SPAC process for the company that's looking to go public.
So in your investment strategy, where are you playing in the spectrum of providing the equity for the initial sponsor to trading it along the way to post-announcement?
Well, in our business, we're actually kind of doing all of that. So we sort of have parts of our business that do all of that. SPAC Plus specifically just goes from the SPAC IPO to announcement or around announcement. And so that allows us, therefore, to make sure that that we're able to, in the worst case, take advantage of the treasury trust value. We have other things that we're working on, which clearly do also extend beyond that point, because we do think, when you look at the Virgin Galactic, you look at the performance of companies that have merged into SPACs, a lot of very interesting companies that have performed extremely well. And we think there are a lot of investors out there who may not want to do the work to specifically, buy this SPAC and that SPAC, but we may be able to provide investment products that actually allow them to participate in that ramp of those companies as well. So, we think there are a lot of different areas. We also are involved in talking to sponsors about potentially providing private equity to invest alongside them in that initial capitalization of the sponsor. So, yeah.
Yeah. Have you thought about the portfolio is there sort of a certain diversification you're trying to get at, number of deals?
Yeah, for sure. I mean, we absolutely want diversification. We've done obviously we've studied the market closely and looked at, what's the best way to get the best return out of that. And the return is obviously dominated by those companies that successfully announce and their stocks pop. So you need to have enough of a representation across the portfolio to make sure that you get those. We think it's better to actually have a broad enough portfolio rather than trying to pick the 10 companies that we think are most likely to, announce a successful deal. By doing a broader portfolio, diversified, as you mentioned, not too much concentration, you can drive very interesting returns. I mean, we have a separately managed account that we've been running for the last few months that has just in the last few months, and it benefited from actually being invested when markets were a bit disrupted in March, but the returns on that have been extremely positive. So we think it's actually something that could provide very good returns for people. We'll see.
How do you see this sort of SPAC market evolving, right? We went from it was a sort of bad form of financing a number of years ago to it's very popular now to, the founders of some of the Silicon Valley ecosystem sort of saying it as this most recent one of hey, you can buy into having board members you want.
Yeah. Yeah. I mean, I think it's going to be, I don't think it's a fad. I think it's going to be a durable trend because there are, as we discussed, there are real positives to the structure. And so I think it serves the management teams well, it serves private companies well. I think it serves public company investors, right? IPO investors well, because this is another avenue they can invest in those companies as they go public. There's, more transparency in some respects. So I think it's going to grow. I mean, I think it's going to continue to grow. I'm sure as with everything, there'll be ups and downs, no doubt. I'm not sure it's always going to be as hot as it sounds right now, but I think it will be an enduring market that will grow over time and provide a good solid mechanism for companies to get public and investors to deploy their funds.
Great. Well, I want to turn to the other sort of product you've been working on with Morgan Creek, which is this digital assets. Why don't we take a quick step back and get your perspective on digital assets, blockchain, cryptocurrency world?
Well, I think from our point of view, we think it's a really interesting market, the whole digital asset market. Again, it's an area where, as I mentioned before, a lot of players play in a sort of fractured way. They might be involved in one part of the business, not in another. We, as I mentioned, like to take a holistic approach to that. We think that also allows us to see opportunities, across the space and get synergies across the business that is really positive. But so we think it's an interesting area. We're not religious about it. So we're not saying that we think, Bitcoin's going to take over the world. We're not, but we do think it's an interesting asset category, and it's possible that it could. I think it's, but it is an interesting category of assets that we think people should probably have some exposure to. And so the way that but again, the way that we think about it is we can take that, what is a pretty volatile area, and we can actually take some of our structuring capabilities, some of our knowledge of the broad sweep of the digital business, and try to provide a way for investors to participate, which is a little bit more, a little bit risk mitigated or moderated by some of the structures that we can put in place. So, and that's exactly the concept that, along with Morgan Creek, we have developed of this Bitcoin Risk Managed Fund. And the idea is basically to be able, as an investor, to participate in the digital markets, but to do so in a way that actually mitigates some of the risk, cushions some of the risk. We think we've come up with, applying what are, pretty, I'd say, reasonably standard risk management techniques that have been, tried and true over, many years. Applying that to the whole digital assets area creates something that we found that we think is actually a really good instrument that does allow you to participate in digital assets, but does mitigate some of the risk.
So there's sort of two sides of that. There are the assets that you're playing with, and then there's the risk mitigation piece. So is this fund just Bitcoin, or is it broader within the digital asset space?
It is, well, it's primarily, I would say it's Bitcoin as the underlying, but some different manifestations of that, right? So there could be lending in there. There could be different aspects of, different, whether it's futures or other aspects within Bitcoin. But that is the underlying. So it's not primarily just that instrument. But then we have a number of risk management strategies around that where we can, mitigate the downside.
And are those trading oriented, or are they structural?
They're more trading oriented. They're more data analytics and trading oriented. Yeah.
And what have you seen about the sort of relative efficiency of the Bitcoin space compared to trading, anything else in any other market?
Yeah, it's definitely a newer market. And so, it certainly has its quirks, and, there are a lot of issues. It's one of the reasons why, again, I would say as an asset category, it's really interesting, but you don't get the liquidity as automatically as you do in other more established markets, which is one of the reasons that we think, a professionally managed asset management product is clearly one that is helpful, because it's hard to, navigating all the issues around that, around, as you say, the execution, the trading in that is, requires some experience and some capabilities not everybody can have. And again, one of the things that's helpful for us is we do have a spread of activities. So we do some mining, we do trading, we do electronic trading within that, we do some lending, some facilitation, as well as the asset management side. And so all those pieces give us not only knowledge around the market, but it also, in many cases gives us outlets for liquidity, et cetera. So that is important.
Well, Brady, it would be very easy for me to monopolize all of your time, and I'm seeing this flood of questions coming in. So we'll postpone that for a time when we do this on the podcast and get a fuller conversation. But in the interest of time, I'm going to turn to some questions coming in. So here's an interesting one. What are your views on potential disruption by cryptocurrency, and especially asset-backed coins like stablecoin, and the impact they could have on retail banking?
I think there are a lot of really interesting possibilities there. And I think it will probably develop over time. I think it's obviously, to date, it's developed a little more slowly than I think people would have, some people would have predicted or guessed. So I think actually, and we have a lot of structures and concepts that we're working on that we think are really interesting in that area. But my guess is, the adoption is not going to be so rapid that it's going to disrupt things dramatically. But I do think there'll be interesting developments there. Hopefully the regulatory side also will continue to develop, because that's been a piece that's, slowed things down a bit. Not unreasonably necessarily, but it's definitely slowed some things down. but so I guess what I'd say is I think there'll be some very interesting developments there, and it's definitely an area that we're watching and people should watch. But my guess is you're not going to see anything revolutionary. You know, I think things will evolve over time, but nothing, you know, nothing too dramatic or sudden.
Okay. How do you allocate your time with so many different business lines going on and you're within Exos?
Oh, it's a good question. You know, it's one of the things one of the things I say when I compare my previous life to this life is, you know, when I was the CEO of Credit Suisse, my calendar was set for the next 2 years. So, you know, 2 years from now, I knew on, you know, September, you know, 25th, exactly where I was going to be. I had to be at a board meeting, or I had to be with a regulator, or I was spending the day in Sao Paulo or whatever. And the interesting thing about a business like Exos is that I'm not even entirely sure what my schedule is going to look like tomorrow. So, you know, things are, you know, and that's actually a really positive thing about the business is we can be very responsive. We can, you know, really move quickly and be nimble. And, you know, that's a kind of a cliche, but it's definitely a huge advantage, I think, that we have over large organizations. But, you know, so it's a really, I guess it's very, you know, I have to be very flexible and responsive with my time as well. So, you know, a lot of it is, you know, thinking about how to either build new businesses or expand the businesses that we have. A lot of it's talking to clients and, you know, counterparties in the business. A lot of it's working with obviously our team here, which is extremely talented. And we, you know, meeting a lot of these challenges, whether, you know, doing things in a pioneering way like we're doing is, it's definitely challenging. You've got to have people who have the right mindset and, you know, the right, you know, the grit to do that, because it definitely takes a lot of hard work, but it's very satisfying because you can, you know, creating new businesses and new ways of doing things is, you know, there's almost nothing more satisfying, I'd say.
And what's been the biggest unexpected challenge?
Well, you know, I guess what I would say is, I have been surprised at how, and some people would say I shouldn't be surprised by this, but been surprised at how slow moving large organizations are. And so, you know, for us, we try to work with other financial institutions. And a lot of times we need to work with them. They're providing services with us. And that's been something that's been surprising to me. But as you say, I mean, I used to run a large organization. So some people would say, well, your organization was probably the same way. I mean, you don't know that. But I never sensed that. And I was always pushing very hard to get things to move and to move quickly. But it's just, it's interesting to me how, you know, how hard it is to get large organizations to move and to do things. So I guess that was probably outside of my expectation of how hard. I knew it would be not easy, but how hard it's been to do.
Okay, we've got a few questions. Time for a few more. We got a couple relative to the fund. So here's one in different iterations. Spac Plus seems too good to be true. What's the catch?
I don't think there is a catch, but obviously people should look at it. It can talk to, I mean, Morgan Creek is marketing it, so we've got plenty of materials on it. I honestly think it is I guess that's what I said. I think it's a really good product. So I'm not sure there's, you know, I mean, obviously you're not guaranteed to have that kind of upside, but I think given, you know, the way the SPAC market's been going, I think there's a pretty decent chance of that. I mean, obviously you could invest in the fund and, you know, the acquisition market shuts down for some reason. I can't see that happening, but, you know, if for the next 12 months, you know, there are no acquisitions, SPACs don't do any mergers, then you'll end up with more like a treasury return, which wouldn't be great, but it's not the end of the world, I guess. So, you know, so I think it's a really well-designed product and it's a good product. So I can't think of what the downside is. So, but people should look at it themselves, obviously. And anybody from Morgan Creek or Exos is happy to spend the time with you if you're interested in drilling down more on it.
Okay, and then on digital currency, how do you think about the risk of an as of yet unknown digital currency supplanting Bitcoin?
I think I guess it's sort of the way I think about the digital side altogether, which is I think it's an area where you have to entertain almost any possibility. So I think you know, when we think about it, we're never of a mindset of, well, that'll never happen or that'll never happen, because it's a dynamic enough area that I think you have to consider all possibilities. I think when you understand the whole sort of food chain within a digital currency, though, again, I think it could happen, but it would take, I would say, a fair amount of time for that to happen. You know, could it transition? It could. I think it's unlikely, not impossible, but it would also take time, because, you know, it's everything from, you know, where most of these currencies start with mining. There has to be actual hardware that does it, you know, to create. So, and you know, that's like, there's not a, you know, for a currency that was just created. So if you and I created the most amazing new digital currency that everybody would want to use, if we started today with that, I think it would take a year or two before that could actually be something that could become broad enough in usage. There's enough out there, there's enough liquidity that people would use it. So, I mean, it's not impossible. Nothing's impossible. And as I say, in this area, I think that's very dangerous to take a point of view that, well, that will never happen, because anything could, but I think it's unlikely.
Okay. Well, I'm going to go with one more. You know, having gone from a, let's just call it slow moving, regulated investment bank to a boutique, wonder if you could comment on the regulatory environment and what changes you think are coming, and maybe what you think should happen.
It's interesting. I mean, I think that, you know, I was always of the point of view, I guess I was, you know, we considered ourselves at Credit Suisse to be kind of more in the, I would say, responsible camp, in that our view was, you know, what happened in 2008, and that was not, you know, what happened in the banking system was not great. And so measures had to be taken. What we always tried to do was work constructively with the regulators to come up with measures that would accomplish goals of making the system more resilient and more stable, while still allowing the banks to do business, because they do have a function. And I think actually, you know, over the course of, you know, the past, you know, 10 plus years, I think that's actually kind of worked out okay. You know, I mean, the financial system, I think, is more stable now. It is, you know, I think better structured. And yet they've continued to be able, for the most part, to facilitate business. I mean, we still find there are a lot of areas that we see where, because of regulations and things, the larger institutions can't participate. And so we see opportunities there for very good, you know, healthy, you know, wholesome business. But by and large, it's actually worked reasonably well. I do think that, you know, one of the challenges is going to be accommodating new ways of doing business, you know, technology, for instance. I mean, one of the things that we hear sometimes from participants in the market and even regulators sometimes is this question about the cloud. You know, isn't the cloud, you know, isn't there a risk in the cloud, whatever. I mean, our view, Joe Squarey, who I said is our head of technology, he was actually at Google for a couple of years and was a senior executive in residence running their, or working with them on their data center business, their product, the AWS equivalent at Google. And so he went around to financial institutions talking about adopting it. And, you know, his view is like, you know, as compared to an individual company with its own security people and its own, the amount of resources at a Google or an AWS is massively bigger. It's much more secure. And yet you do have, I think, you know, not all regulators, because some have actually made the leap, but a lot of regulators would say, well, you know, I'm not sure being in the cloud is really, you know, is that really safe, or are you going to be more vulnerable as a financial institution? You're probably safer. So I do think that, you know, adopting to the new technology, the new world, is probably something that's going to take, you know, will be a challenge and that we'll need to do. But I don't know. In general, I think the regulatory world and the industry are getting it right. Hopefully, some of the up and coming firms with new approaches like Exos will be able to, you know, carve pretty big, you know, footprints there. But, you know, we'll see. We'll see how it works out.
Great. Brady, really appreciate taking the time, and thanks everyone for showing up today.
Thank you, Ken. And thanks everybody and the Investment Institute. Thank you very much. It's a great forum. And Ted, thanks. It's great. Appreciate it.
Pleasure.